session. Council, the finance meeting and services meeting is back in process again, and I'd like to welcome Alex Windhoek to our meeting, and I'd ask Janine if you wouldn't mind just giving Alex a bit of a brief introduction.
Yeah,
Please.
thank you, Mr. Chair. Yes, so Alex is our Treasury advisor working through PwC. So any advice that we're requiring around our borrowing program and also some of those forecasts in terms of where interest rates are heading on our investment side, excluding the investment fund, obviously, that's with Macau. Alex is our go-to. I think we've been formally engaged with PwC probably going back to 2018, particularly when we were establishing our borrowing program with the local government funding agency. So this is actually the first time in this triennium that we've had Alex presenting to this committee, but thought it was a really good opportunity to do so. There's obviously a lot of activity happening from a market perspective, but in conversations that we've been having recently, also with that, a lot of opportunity for council to be looking at different ways that we can manage some of that interest rate risk moving into the future, which will be beneficial to us. So yeah, I'll hand over to Alex, who's got a presentation that he'll work through. I'm sure very happy to take any questions from elected members as we work through it. Thanks, Alex.
Perfect. Thanks, Janine. And yeah, good morning, everyone. It still is morning, I think. Very happy to take questions along the way. So this is my first opportunity for a wee while to be in front of you all, and probably the first time I'm meeting a number of you. So I am a partner at PwC's Corporate Treasury Advisory team. So helping and supporting council in terms of decision making around the borrowing program and strategy. So where to borrow, how long for, and then the management of that borrowing, in particular the interest rate risk associated with that. So interest rates, inflation, that's my wheelhouse. So reasonably topical. So I've got a short presentation here today, really taking through into the sort of agenda, which is on the next page or slide there. What we're doing in terms of treasury management and the policy framework that you have in place. So the policy being the liability management and investment policies, which together called the Treasury Risk Management Policy. Very brief sort of oversight in terms of what's happening in the world and the economic and financial market outlook, and some of the recent movements from the Reserve Bank here are very timely in terms of this discussion. How you're currently positioned against your policy parameters, so where your funding and interest rate positions are against policy, and then also strategy alongside that in terms of forward direction, in terms of borrowing that you require and the management of interest rates thereafter. And then just briefly touching on a topic that I believe was raised about 12 months ago in terms of obtaining a formal credit rating. So two credit rating agencies prevalent in New Zealand local government, Standard & Poor's and Fitch. So talk through some of the pros, cons, opportunities that go alongside obtaining a rating, credit rating as well. So on the next page, and I think it's probably a bit of a cover page, so maybe just move through one more. Here's what your policy is or does. So it covers your delegations in terms of where you as councillors are providing management capacity to operate within the policy, to be making those decisions, when to borrow and how long for, and how to fix the interest rate risk on that or otherwise. It talks to your liquidity and debt funding. So liquidity, in terms of the way we think about that, is more the short-term access to capital. So this is dictated to by covenants through the LGFA in terms of maintaining a minimum buffer and a headroom above your existing borrowing. But it also speaks to being able to keep the lights on, so paying your suppliers, your contractors, your employees, physical lights, so access to that capital as well. Does speak very briefly to your investments, albeit I've just taken over the hot seat here from someone who's far better qualified than I am to speak to that. So briefly touches on whose responsibility that is. not ours. And then around interest rate risk. So this really is talking to fixed versus floating. So essentially, how much certainty do you want or need or require? And really that's around delivering to your plans, your budgets, your policies. So getting that certainty by the nature of your activities, your organisation who prioritises intergenerational outcomes. You have a longer term focus. That stability in terms of some of those outcomes is preferred, right? As opposed to perhaps a corporate who could take a slightly shorter term view on some of those decisions and pass through changes more frequently or readily than what your community would like to see from you. So stability is certainly valued there. Talk to operational risk management. So in terms of some of the practicalities around managing some of these risks, but also the internal controls and segregation of duties, and then your counterparty exposures. So who are you dealing with? And are they upstanding and likely to meet their commitments to you? So banks and the LGFA are key counterparties there within your treasury management activity. Just skip through to maybe just giving now a bit of a background in terms of some of the outlook for economic and financial markets. And these aren't my forecasts. These are the Reserve Bank's. So if they're not right, talk to them. I think what's kind of evident there from the chart is growth is pretty anemic at the moment. That's going to be very little surprise, I would expect, to anybody in this room, talking to your friends, neighbours, colleagues. It's tough going out there in the economy and expected to continue to be so. In about a month's time, we will see the GDP result for the second quarter, which you can see on that bar chart there. The Reserve Bank is expected to be negative, as they're also expecting for the quarter thereafter. You've probably heard a saying about 2 consecutive quarters of negative growth. So the Reserve Bank are expecting a more recessionary type outcome, which again is probably no surprise given the confidence that's in the market at the moment and the economy. Thereafter, picking, things are going to normalise and stabilise, and it's going to be smooth sailing thereafter. TBC. Part of this, obviously, is and the recognising of this is the mood for change and where the Reserve Bank cut the OCR 2 weeks ago, just under 2 weeks ago today. And there was a pivot, quite a material pivot from what they said 3 months ago in their forecast, which was there's a possibility we may raise rates over the next 12 months. In fact, it's baked into our forecast. And 3 months later, their forecast suggests we will cut interest rates by 100 basis points over the course of the next 12 months. Bit of a U-turn, but reacting to the data that's in front of them and the economic situation that's presenting as well. Just on the next page or slide there. Here's where interest rates are and or expected to be. Appreciate there's lots of lines and lots of dots, so I'll try to simplify that. The bottom 2 lines are market projections. So where financial markets are estimating, implying the OCR will be over those future periods. Top 2 lines, the grey lines in different shades, are what the Reserve Bank have told us. So what they told us a couple of weeks ago and what they told us in May when they last released their forecast. So obviously a fairly substantive movement lower from the top line to the bottom line, i.e. 3 months ago versus today, but still also a material delta between what the Reserve Bank are telling us in terms of their forecasted path for rate reductions versus where the market is implying the pace will need to be. And herein lies the opportunity. So you are a borrower who is exposed to the market interest rates and able to hedge your fix at those market rates. And maybe just draw your attention to the kind of last dots on the kind of market chart versus the Reserve Bank's estimates there. So roughly 12 months from today, July 25, the current market implied OCR is about 3.25%. Reserve Bank forecast from just under 2 weeks ago bearing in mind, these are the people who actually make the decision, estimating that the OCR will be more like 4.25%. The market has essentially priced in twice as many rate cuts or twice the pace of rate cuts than what the Reserve Bank has told us, which is reasonably aggressive. Obviously, this is premised on inflation falling materially as well. That is the key KPI of the Reserve Bank. In fact, it's pretty well the only KPI. So previously they had a labour target. Incoming, the recent change in government removed that, just focus on one thing and one thing only, that's getting inflation within 1 to 3%. It's currently not expected to be so. But that kind of pace of change is quite a move. It's quite a move in a very short space of time. And so we'll talk to that in terms of the strategy and how you might be able to take advantage of that move. Just on the next page there, is a kind of another sort of representation of even just the change over the last month in terms of interest rate settings. So where the interest rate curve, so this is the kind of various points in time out to 10 years, has changed over a month, July to today. So you can see the OCR has reduced, and BKBM being a reflection of the OCR, so BKBM can understand that as floating rate, has moved roughly 25 points lower, and that's where the Reserve Bank moved the OCR lower. Some very big changes in some of the short-term rates in particular, and so kind of pointed to some of the 2-year interest rates especially. So in the last month has moved over 1% lower. So the market's expectation is that floating rate will average over the next 2 years is 1% lower than where it was a month ago. Just saying the same thing. Quite a lot, quite a big move in a short space of time. So if we move to the next page. So in terms of your total borrowing costs, it's a component of that floating interest rate or those fixed rates as you use hedging instruments to create that, as well as your borrowing credit margin over and above that. 99% of your borrowing presently is through the LGFA, as it should be, because that is your lowest cost of financing. It offers greatest flexibility, terms, tenors. Every single council now, including the Chatham Islands, are a member of the LGFA. So it is a jointly owned and multiply owned CCO. But what I'll probably just point out here as well, and you can kind of see again from the squiggly lines, too many lines, but the trend is there. Those margins have been increasing. So the LGFA, in terms of their borrowing costs and margins, which they charge to you, has been increasing. Probably just want to contextualize this a little bit though as well. So even if we pick the kind of very top line there and an assumption that you borrowed through to April 2037, which is a 13-year tenor, you probably won't, but you could. That's moved up from 2 years ago, under 100 basis points up towards 150 basis points. So we'll call it 50 to 75 basis points of increase. Over that same time period, we've seen the floating rate and that BKBM and those swap rates move more like 500 basis points. In terms of your total borrowing cost being the combination of the two, if you're 150 basis points from this component, about 400 basis points on the equivalent kind of floating rate. So still weighted towards close to sort of 3 times the importance on where's the OCR, where's the floating rate going versus where are these credit margins moving. So probably not going to borrow elsewhere or differently. A bank will give you a price. It'll be higher than this again. But just highlighting that there's also upside pressure here in terms of LGFA's funding costs and margins. Why is that? Why is that? Because generally the credit quality of the sector is declining. It's declining because debt levels and borrowing levels are increasing. The ability to service is under pressure. There are rating agencies that are taking action on councils around negative watch or downgrades. Obviously, plenty of conversation around waters, the ability to leverage that, what that's going to look like in terms of debt to revenue ratios and caps. It's increasing leverage and capacity in the sector, which doesn't improve credit quality. It says the credit quality is diminishing. Hugely but somewhat, and that's reflected in market pricing and investor appetite and demand as a result. Just onto the what you look like in terms of your profiles and positions. This is your physical borrowing maturities. So currently spread over a 5-year tenor and period. Combination of some borrowing that has been undertaken on a floating rate basis and some that's been undertaken on a fixed interest rate basis. You're compliant with all your policies and ratios. So you have a spread of maturities to make sure there's no excessive concentrations in any one point in time. So you're not susceptible to those market conditions may be at that one point. You do have compliance with your liquidity policy and ratio as well, i.e. maintaining that excess and that buffer. So that's an LGFA borrowing covenant requirement. It's also in your treasury policy. This is a position, obviously, that's going to start changing over time. And in fact, it's likely to change very soon on the next page because there's a requirement under your expected debt forecast to borrow an additional 10 million. So we've recommended a strategy to Janine and the finance team here in terms of 2 further $5 million borrowing tranches. We're looking to extend that duration and maturity, so ensure that you remain compliant with your policy framework and parameters, align with what you're funding, which is generally longer term assets and longer term lives, and so you have slightly longer term borrowing maturity towards that as well. Both of these borrowing tranches we're recommending as fixed rate borrowing. The reason we're recommending that as fixed rate borrowing is coming back to those charts earlier around the market implied pricing around interest rates and interest rate settings. Very aggressive in terms of that pace of decline. So, and maybe I should have said this earlier, I'll say now, the pace of decline that's being implied would require the OCR to be cut at every single meeting between now and July next year, with 2 of those meetings being 50 basis point cuts as well. It's quite a lot. And when we think around, even if that happens, how much further could it go in terms of what's the opportunity cost of doing that, and it continued to move and we didn't capture the full extent of the movement? Hard to see there being 350 point cuts placed over that period. And even if that happened, then it's the averaging of that and it will be a small basis point delta. So it feels like a fairly reasonable recommendation for us. At least we believe it's a fairly reasonable recommendation to make to you at this point in time to take advantage of that market pricing, which is wholesale rates in the mid 3% essentially over those periods, which we had this conversation in April, I would have said these are more like mid 5s. So the kind of the movement in a short space of time is quite material indeed. So just on the next page, this here is your profile, which represents how fixed you are. So of that borrowing activity that you currently have, but also your forecasted borrowing activity. So that's the red line. How exposed are you to the floating interest rate movements? And you have policy bands within that. The black bands are where you're looking to get the shaded area within or between. As you can see, this is the shaded areas outside of that. So it's below your minimum policy requirements. Some of that borrowing activity that we've just talked to on the previous page resolves a good deal of that. So if you actually move to the next here, this will show the impact of that. So borrowing an additional 10 million on a fixed rate basis does increase your level of fixing and minimum cover. Doesn't quite resolve every single bucket of compliance though as well. So there is additional activity and recommendations that we are making in terms of taking advantage of the market movement, but re-establishing not only compliance with policy, but our recommendation is going to be very heavily weighted towards the shorter end of your maturities towards a maximum policy band. So out towards a 2-year period, given the extent of that market move, and maybe I'll just extrapolate that further, market implied OCR at the end of next year is 2.8%. So in order for market pricing to be realised, the OCR will need to be 2.8% at the end of next year. It's currently 5.25. So it's a very long way to move in a short space of time. We don't believe that's going to happen. We believe, therefore, you have an opportunity to lock in that market sentiment, hedge to a very high degree today for the short term, which is going to secure your plans and your budgets, probably substantially what you budgeted even in the recent LTP, given the pace and change of movement. So, and you saw that chart, just of where July is versus August, almost a 1% movement even over that period. I mean, it's even more pronounced going back to June and when you were setting some of those budgets. So we think there's a strong opportunity here to capitalize and capture the market movement and sentiment that's here. We don't believe the Reserve Bank are going to have the ability or the desire to cut at that pace. They've just spent 3 years outside their one and only KPI. They're not going to be particularly excited about doing something materially different. The opportunity they also have today that they don't typically have is the pass-through mechanism of what is the impact of making a rate change? How am I going to know what impact that's having on the economy or inflation? Is actually a whole lot swifter today than what it normally is. So when the Reserve Bank changes the OCR, primarily they're seeing the result of that through refixing of retail mortgages. So a mortgage comes up for a renewal, it's now a higher rate, it's a lower rate, and I react to that, and that flows through to the economy, spending behaviour, my disposable income, my capacity to meet pricing changes. Typically speaking, New Zealanders have been fixed for about 2 years. Fixed rate mortgages are pretty well 2 years. People roll over for 2 years. The average mortgage tenor today is 9 months. So the kind of pace of information response for the Reserve Bank is a lot quicker than what it has been traditionally. So what they've had to do in the past is they've had to make bolder decisions. We need to raise by 50 points. We need to cut by 50, whatever it might be, because they're not going to get that full visibility of what the impact is for a protracted period of time. Today, they can afford to be slower and more deliberate. They're going to see it quicker than what they have in the past. So again, kind of reinforces they don't need to be as aggressive as maybe what they would have had to be in the past. Which again goes to the recommendation, which is we should fix a reasonable amount in the short term here and capture the market movement. That's the follow-up recommendation that's going to be coming alongside this one, which is soon to be implemented as well. I'll just quickly pause there before we get to kind of considerations around credit ratings if anybody's got any questions. Or I'm happy to wait to the end. I've only got one more slide.
I think if you just finish off, please, Alex, and then we can come back to questions.
Perfect. So just on the last page here around kind of credit rating considerations, desirability or not of obtaining credit, and appreciate there's too many bullet points on a small page there, really goes to what's the economic benefit to me of doing this. There's a cost of obtaining a rating and there's a cost of maintaining that rating. That cost is around $60,000 a year, plus or minus depending if you're with Fitch or S&P, but broadly speaking, that's the cost. And you'll pay that every single year. So the economic benefit needs to outweigh that cost probably as a starting point in terms of how do I get that benefit? Get the benefit because the LGFA reduces your borrowing margin based on your credit rating outcome. So you get an immediate benefit if you've got a rating, you get a maximum benefit if you obtain the highest rating that they provide a discount for, which is AA plus or AA. Going through the process and understanding your particular metrics and how you might be viewed, I'd suggest you're going to be close to that in terms of what that benefit is. So what that benefit looks like from the LGFA at a AA plus or a AA rating would be a 20 basis point reduction in your borrowing costs. So that 20 basis point needs to stack up in terms of any debt that you're coming up for refinancing, which you've got 5 million within the next 12 months. So that could be repriced 20 points lower than otherwise, as well as any new borrowing that you have. So that red line on that chart showed a fairly sharp increase in the level of debt and borrowing. So I'll leave that to you as to whether that's able to be achieved and realised or not. But where there's confidence in that, there's an opportunity here for you to consider there being a lowered borrowing cost as a result of obtaining a rating because your debt level suggests that you're going to be able to capture it. Goes to obviously a few other points there as well in terms of instilling financial disciplines and showing transparency to your communities and ratepayers around the financial management and standing. Another, common detractor or comment would be, what's the impost and time that this is going to have? The answer to that is reasonably limited. It's probably a day, a year. And the reason for that is the vast majority of the information the rating agency needs is publicly available and you produce it already. So it's not substantial in terms of what your commitment is going to be in terms of time and Janine's time. But there is potentially a reasonable reduction in your borrowing cost as a result of obtaining that as well. So that's a consideration that you might wish to have. And we can help work through some of the mechanics as to when that tipping point is around this is going to make economic sense. It may not make economic sense immediately, i.e. year one, there might be a net cost of that. But over the 10-year horizon, I'd say it's very likely that there's going to be a net benefit over that period.
And I think, Alex, one of the key points for that is that the credit rating is only applicable for debt taken out after that. So you can't retrospectively reprice.
Yeah, the LGFA is not going to re-rate your existing borrowing and give you a rebate on that. It'll say, once it comes up for refinancing, sure.
Yeah.
But we're not going to give you immediate discount on everything you've got else.
So it's not necessarily even the total level of borrowing, but it is taking into account those refinancing periods as well.
So through the chair, just to help the councillors, so is the simple math that you need $30 million of debt at 20 basis points to recover the $60,000 to be equal?
Yes.
Yep.
So it's that at some point, and then once it starts exceeding that, obviously, and then it starts being a benefit. So initially or immediately, you might be inside that. You've got $5 million in refinancing. You've got new borrowing in the near term that might take that down from 30 to 15 or 20 that you might have in the first year. So your net cost is going to be on sort of 10 million. But thereafter, in the years thereafter, I think it's going to start paying back. So the payback period will be every year would be a estimate at this point.
Thanks very much for that, Alex. I guess my comments for what they're worth is that we've been very conservative, council's been very conservative in terms of estimating what its borrowings are going to be. This year we're 22 less than what we projected at the beginning of the year. And given the funding that's coming through from central government to assist with some of the capital projects, I'm suggesting that may well continue longer than what our projections are showing. So, there's going to be, I believe there's going to be a need to be some pretty robust work taking place internally, because I'm not a great fan of spending money when you don't need to spend it. And $60,000 is $60,000 at the end of the day. And unless you're going to get a payback from it reasonably quickly, then I'd be deferring that expenditure. Having said that, however, you've got this arbitrage between the existing and the future interest rates may assist with that process. I haven't seen any numbers, but presumably you've done the numbers and Janine's got them tucked away somewhere. So I'd like to think that we can explore these opportunities, and if they present positive outcomes for the council, then obviously we'll be talking to the rest of the committee here and taking it forward to full council for a decision. So yeah, thanks very much. Very informative. I guess my last question is, what trust have we got on the RBNZ to get it right?
Yeah, and so you might have seen a number of news media articles that were less than glowing in terms of their change of direction in a short space of time. I mean, ultimately, they are making the decision. Their view and how they, and maybe I just provide some colour as well in terms of why they're expecting an ability to cut. Their previous forecast in May had inflation for the coming quarter at 3%. they now expect that will be 2.3%. So well within target band. So rather than the top of the 1 to 3% band, well within it. The construct of that and how that's achieved is not necessarily the work that they're doing in getting non-tradable core inflation lower. So non-tradable core inflation being rates, insurances, electricity, utilities, bills, that I know all of us paying more for, a lot more for than 2% per annum. The heavy work and heavy lifting is being done by the tradable component of inflation. So that's importing goods and services and the cost of doing so. Their forecast for tradable inflation for the next quarter is negative, substantively negative. A combination of bringing things in cheaper, EVs, fridges, bikes, oil, cheaper than what we were doing previously in the previous quarter, alongside reasonably sticky and elevated non-tradable inflation, still above 5%, is still going to see the overall headline measure at 2.3. That's what they're benchmarked on. They can't influence they can't influence tradable inflation. That's not in their capacity. They can't tell the Saudis what to do with the price of oil. But they can or should be able to influence domestic spending habits and behaviours and influence that non-tradable inflation, albeit that's proving very sticky.
Thank you. I guess my only comment on that is they can only influence so long as we listen. Therein lies the problem. Yes, the Prime Minister delivered the message last week. Hopefully that's the message being brought back to Council by those that attended. Does anybody else have any questions for Alex? Warren, sorry.
Yeah,
Yes.
yeah, just quickly, Chris, and I agree with your comments around the credit rating, but just one other point. I just wonder, has there been any influence ever in the government with loaning or, getting project money out for a council that has got a credit rating? I just wonder if if anyone's ever seen a benefit around actually having a credit rating for government money. The shaking of the head, I'm picking no. No. I just wondered if it was an additional benefit, possibly, given some of the debt caps.
Does anybody else have any other questions? I thought the Chief Executive might have some for us to put a direct line of access, so that's all right. Okay, well, Alex, thank you very much for your presentation.
Thanks for having me.
It's a pleasure, and yes, it's good to get an update on just what's happening out there and the opportunities that Council can explore to, make a contribution to reduce the burden that we're putting on ratepayers. So thanks very much for that. So I've got a mover for this resolution. Do I have a seconder? Thanks, Robbie.
Who's the mover?
Mikhail and Robbie seconded. All in favour? Against? Carried. Thanks, Alex. We'll let you get on your way. All right. Thanks very much. Right.
Mr. Chair, shall we carry on with, there's just the staff treasury report and then that
yes.
closes out all of that.
Thank you. Thanks, Janine.
I don't think there's anything additional to note in there that we haven't covered through the reports, probably just in terms of the equalisation reserve. John from Macau had noted the improving position around that deficit. So the deficit equates to about 2.8 years of rate subsidy, which is unchanged, but we'd gone quite a way down and bounced back with that as well. So that's probably the only point within that report to note.
Thanks, Janine. Does anybody have any questions, Janine, on that? Self-explanatory. And it is good news that the investment fund is recovered quite quickly. The War report was 12 million in deficit, I think, when we started talking about this time last year. So it's a significant turnaround. Right, so we have another resolution.
From the state, Janine?
6.6.
6.6, yeah. So we're jumping around there. This is testing your skills.
Keeping it on its toes.
Okay, Treasury Management Monitoring Report, 30th of June. So do I have a mover, please? Robbie, thank you. Carl, all in favour? Against? Carried. Thank you, everybody. And with that, Jane, I'm sorry to take you away from your team. So now to go to the non-financial reporting statements, which is 6.3 in your agenda. It's page 28.
Morning, councillors. So as you'll be aware, councils are required to set performance measures in relation to their levels of service through each of their long-term plans and report their performance against these targets through each annual report. The report in today's agenda provides the committee with a draft year-end position on our non-financial performance, just noting that these results are still subject to a review by Audit New Zealand before they are published in our 23-24 annual report. As noted in the report, there are 51 measures in Council's 2021-2031 long-term plan. 44 of these measures are reported as having been achieved, 6 measures as being not achieved, and 1 measure as being achieved in part. The 7 measures that have not been achieved have all been highlighted to the committee throughout the 23-24 reporting period, and their performance has been forecast as either been off track or has been monitored at the end of Q3. Also noting that previously there were 2 other measures that were off track, which have now been achieved. So the purpose of the report is to request approval of these draft measures for release to Audit New Zealand prior to being included in the annual report. I will leave it there unless there's any questions about specific measures. Thank you.
Thanks very much. And I guess my only comments is I don't see that we've on page 32 that we've got a fail. I mean, you're knocking yourselves around for something which is not required to be delivered, and I don't see that as a fail, but that's just the way I live in this world. Don't have to do it, then you don't. So, Stu, you've got a question, please.
Well, just a comment, really. The review process, look, we've got to go through, happy to support these going through to the auditor, but some of them I think, acknowledging it's got to be an ongoing process to make sure they're fit for purpose. That one about the SCIF, small scale community initiatives, that's just not fit for purpose. For all of the fund ones, it's a number that number of projects we fund, not what the impact of our funding is. And because we've funded lesser, bigger projects, to fail.
Doesn't make sense.
Exactly. And look, I'm not saying we've got the answers, but I think that's one that we really need to review. We're just shooting ourselves in the foot. It's not delivering any meaningful information that we can use to improve ourselves with.
Likewise, when technical issues, you mark that as a fail. Technical issues are technical issues. Sometimes you don't have any control over that, so you shouldn't be punishing yourself for non-delivery. Yeah. So, anybody else have a comment?
Just for you, Mr. Chair. Jane might want to comment, but some of these have lasted through the last few years, and we recognised quite early that, crikey, why were these put in place? Because they sort of hung us out to dry, really. And audit holds us to them. We haven't, been able to do much. And sometimes we like to say, well, they're kind of not achieved, but they're not. There's good reasons for it, but that we still got to put in not achieved. They're classic examples one just gave. But we have changed some of these, Jane, in the new LTP.
That's right. So this report will be the final one that relates to the 2021-2031 long-term plan. So when we bring forward the next set of results, it will relate to the new measures, and there have been a number of refinements and changes that we hope will allow us to perform better.
So these outcomes will be reported in this year's annual report.
Correct.
Okay. Understood. All right, so we've got a move for this resolution from Michaela. We have a seconder, please. Pamela, thank you. Don't look up, otherwise you'll be called. It's like an auction. All in favour, please say aye. Against, carried. Thank you. It's like buying sheep, Pam. Right. Moving
Great.
forward. My run sheet. Seven.
Page 91.
Page 91. 6.7. Seven, that'll be Janine, no doubt. Yes. Okay, so Janine, I'll pass over to you to.
Thank you,
Yes,
Mr.
super.
Chair. So this is just an update in terms of our rates collection activity for the year to 30th of June. Noting that pleasingly, we continue to be able to maintain our collection of current year rates at around that 96% level. We've provided there for you a summary of the rates remissions that have been granted this year versus last year. So you can see where that sort of rates relief or concession is being given. We note in terms of the rates arrears balances at 30th of June, so for the rates prior to 1 July 2023, there was $6 million outstanding, and that's been reduced to $3.5 million as at 30th of June 2024. On page 23 of the report is the graph that councillors had asked for, which shows both over the last 5 years, the total rates assessed versus what we've collected. So you can see that 96% collection coming through there of our rates collected are always slightly below the rates assessed, but then showing that collection percentage over the course of the year as well. So I'd just note in terms of the various months that are being reported and the type of activity that's happening to increase that collection rate over time. Obviously, 31st of October is our due date. So we receive probably close to 3/4 of our rates revenue and at that point in time, with people just paying their rates in one lump sum. So large cash influx there. In beginning of January, further collection activity happens as we apply another penalty. So that's applied, so generates a lot of call activity, potential remissions of those penalties from people who then will take payment action. And then between April and June, which is a slightly quieter time for the rates team, they are really starting to turn their attention to that collection action. So they'll start sending out reminder notices, making some phone calls and that type of thing to try and assist our ratepayers be as up to date as they can by the end of the financial year, and thereby avoiding penalties come early July each year. So that was a new piece of information that the committee had requested. I'm hoping that's in line with what was wanted. If it's not, certainly happy to look at how we can present that information differently.
Thanks, Janine. That is useful, gives us a good graphical explanation. Rates charged and rates collected, and I'd just like to compliment the collection team on being able to get 96% in what's deemed to be a pretty challenging economic environment out there. So I think that's a superb effort. So you can pass my thanks back to them, and the committee's thanks back to you, I assume. Just in terms of penalties, the figure that you gave before in our actuals for the year, is that monies actually received, or is that what you've levied for penalties?
No, so that number is total penalties that have been applied and not remitted. So more of that's actually been applied, and then if people have got a good payment history, they've just missed one payment, for example, we will give them a period of time in which to settle their rates or enter into a payment arrangement. And if they meet that, then we will remit the last penalty that's been applied to them. So the revenue that the $1.5 million favourable revenue in terms of that is what is left as a charge to those ratepayers.
Okay. So some of it's already been collected, obviously.
Yes, yeah.
Good, thank you. Anybody else have any questions for Janine? If not, we have a resolution. Suspects McCarley's at the front of the queue today. Thanks, Stu. All in favour? All right, it's carried. Thank you. Right, we should, the next agenda item is tenders board. 6.8. Page number 94. Janine, you'll be no
Yep.
doubt speaking to us. All right.
Yes.
You are,
Me.
you are.
Yep.
Good, yes.
Thank you, Mr. Chair. So this is the report that we provide routinely to the committee in terms of those contracts that have been approved by the tenders board, which is made up of members of the executive leadership team. Anything through the tenders board has a value in excess of 250,000. So anything that is over and above the delegation that directors hold, where council funding of more than $2 million is being put into a contract, then that's where you will see them coming through this committee for final approval as well. So provided there for your information for transparency, happy to take any questions on any of the individual lines if members have them.
I've got a couple of questions. Variation of the contract for the specialist marine project management. That I assume is a consequence of the lack of performance by the company that's building the barge. Is this barge related?
That is
So I'm just after the
related.
question why regional council's paying his bill when it's not our fault.
Also, Mr. Chair, we've been told that there would be no additional cost to us.
Okay.
So through the chair, that might be different in terms of the actual construction of the vessel versus Marine Management Limited are providing the project management of the vessel build.
But if this,
I think it's within the approved budget for the project, which might be where there's no additional cost, but the duration of the project is obviously longer than was anticipated.
which means there's an additional cost to council for this management service, which wouldn't be the case if the head contractor was performing in accordance with their timetable.
It looks to me like we're chewing into our contingency.
Yeah, it's being used, contingency is being used.
Yes.
So can we ask that that be, how tight is the
Sorry,
contract
Chris,
of the head contractor? Is there any way we can pass this back to them?
Just through you, Mr. Chair, I do understand that because it was a fixed price contract, and yes, this is all within the budget, including the contingency, that there are possibly provisions around that which will need to be looked at. Now, whether there's council would choose to do it's another matter, but I do understand it was a fixed price contract, so and at times.
So maybe that needs to go on our action list at a later date. The other one I have is really just, I guess, anecdotal feedback, and Robbie may wish to comment on this. It's a variation to the Mangan contracting, which I guess relates to the project out on the Firth. Is that the Firth project? Paparoa, yeah. A comment on that? Not. You may not want to. So what we've got here, we've got an existing contract, all right? And that contract's now being extended, but my understanding is that some of the reasons for that is because the geotech work hadn't been done properly to start with. Which means, and survey work, which means that we're suffering the consequences of a poor tendering process. This is anecdotal. Of course, I'm just Robbie's probably much closer to it than I am. I'm just highlighting that we're being asked to approve things which, when you hear what's going on out there, that there may be reasons why we shouldn't be actually extending that.
Yeah, be nice to understand
Excuse me, just Mr. Chair, I don't think you're being asked to approve anything.
For information.
These have been through the tenders board process and it's just for information.
I guess where the ambulance at the bottom of the cliff, I'm questioning why it has actually been approved.
I understand that. I'm just saying, I thought you just said that you're being asked to approve it.
Well, in effect, if we don't question it, we're accepting it by default. Right? If we don't question these things, nothing happens.
I wasn't suggesting you shouldn't question it. I was just checking that others didn't think you were having to approve it today as such. But we'll follow that up.
Okay, thank you. So, and the other one which stood out was human synergistics. What do they do for us?
So human synergistics for the last few years have provided our the work we've done on leadership and our culture program. As an example, they did the culture. We did the survey, the survey we do every 2 years. The survey in March, we ran it through them. They provide the leadership program that we put all staff through and help lead us on our culture work to have a constructive culture. As an example, I'm using, I want to say Lester Levy, it's the son, Darren Levy, to give me some advice on how we're working with ELT in response to the organisational survey which is done, which is part of my KPI. But they are the provider of the model that we use for organisation culture.
Okay, well, my same observation. That's pretty significant uplift in the costs. So, presumably, they're providing additional services for that.
So,
Okay.
so through the chair, if I can perhaps provide some extra information on that as well. That was one that the tenders board did challenge probably in terms of the length of the extension of that contract, given off the back of our culture survey results, the desire to actually revisit the leadership program and have we got those settings right. But that will take some time to do, hence still having the services of human synergistics in place to allow us to run the leadership program in its current form while that review is undertaken.
Thanks, Janine. All right.
Just through you, Mr. Chair, if I may. Can you expand on that Te Huia Rail Services agreement extension, understanding that we needed to go back for the extension of that within that trial period, but it's down as a proposed variation of over 18 million. That must have,
So that came through the committee.
sorry, it came through.
Through a special meeting of this committee. So it was the meeting we had in the Tui Kowhai room.
Perhaps if I could help you. So that wasn't a tenders board decision to approve it. The tenders board recommended to the committee to approve it.
And so that was to see the service through until the end of that trial period.
I don't believe we've got a choice on that because it's been approved by full council. That's the cost. So it's just approved.
Just the wording around proposed variation.
Yeah, it is. It is what it is. Yeah. Thanks. If there's no other questions, we have a resolution. Is he looking at their phones? Thanks, Robbie. Pamela, thanks for seconding it. All in favour, please say aye. Against, carried. Right, we're heading towards the bottom of the agenda. Oh, sorry, that is it. Thank you. Yes, thank you all. So, Janine, would you like to do the closing karakia, please?
Unahia mai te urutapanui, kia wātia, kia māma, te nākau, te tinana, te hinenaro, i te ara takatū, koe rā e rongo e whakari aki ki runga, kia tina, haumie, hui tai ki.
Thanks, Janine, and thank you all for your attendance and helping get the meeting through almost on time. I think we're quarter of an hour late. There's quite a bit in there. Yeah, there's quite a bit in there today.